While Europe braces for another winter of pain, and families in Germany and Italy watch their energy bills soar past levels not seen since the 1970s oil shocks, a quieter and far more calculating story is unfolding across Asia and parts of the Middle East. Some nations are not merely weathering the storm caused by the Iran crisis, but actively turning the chaos of disrupted shipping lanes, volatile oil prices, and geopolitical realignments into lasting strategic and economic advantages that could reshape the global balance of power for the next decade. As the Strait of Hormuz continues to operate under heightened risk with tanker traffic dramatically reduced and insurance premiums skyrocketing, the world economy is experiencing its most significant supply shock in generations. Brent crude has remained elevated well above the $100 mark for weeks, sending ripples through every sector from transportation and manufacturing to food production and consumer spending. European leaders warn openly of deindustrialization risks as factories face unsustainable energy costs, while American consumers feel the pinch at the pump and in higher grocery prices. Yet amid this widespread pain, a select group of countries, most notably China, India, and Turkey, have demonstrated remarkable adaptability, leveraging the crisis to secure discounted energy resources, expand market share, strengthen alternative trade corridors, and accelerate long-term diversification plans that leave them better positioned than before the conflict erupted. The contrast could hardly be starker. European economies, already burdened by the legacy of the Russia-Ukraine energy crisis, find themselves facing a double blow. Natural gas prices have surged again, forcing manufacturers in Germany's chemical and steel sectors to impose massive surcharges or scale back production entirely. The European Central Bank has been forced to reconsider its monetary easing path, with inflation forecasts revised upward and growth projections cut. Industrial output is declining in several key economies, and there are genuine fears of technical recession in energy-intensive nations like Italy and Germany. Households are cutting back on spending as heating and fuel costs consume larger portions of disposable income. In this environment, Europe appears reactive, struggling to manage immediate shortages while clinging to ambitious green transition targets that now look increasingly expensive and difficult to achieve on schedule. China, by contrast, has approached the crisis with the long view that has defined its rise as a global power. With vast strategic petroleum reserves built up over years and a deliberate policy of energy source diversification already well underway, Beijing has been able to absorb the initial shock better than many analysts predicted. Chinese companies have moved quickly to secure additional volumes of discounted Russian and Iranian crude. Taking advantage of Western sanctions dynamics and the urgent need of producers to maintain cash flow. More importantly, the crisis is supercharging demand for Chinese green technology exports. As nations from Europe to Southeast Asia scramble to reduce their vulnerability to Middle Eastern oil and gas, orders for Chinese solar panels, wind turbines, battery storage systems, and nuclear components have accelerated. This positions China not only as a supplier of traditional energy during the crisis, but as the indispensable partner in the transition away from it. Beijing's state-backed firms are signing new deals across Asia and even parts of Africa and Latin America, locking in market dominance that could persist long after the Strait of Hormuz returns to normal operations. India has shown similar pragmatism combined with bold diplomatic maneuvering. Traditionally, one of the largest buyers of Gulf crude, New Delhi rapidly pivoted to increase imports of Russian oil at significant discounts, utilizing its sophisticated refining capacity to process the barrels and re-export refined products at premium prices to markets facing shortages. The Indian Navy has played a visible role in securing key sea lanes, enhancing New Delhi's reputation as a responsible security provider in the Indian Ocean region. Investments in ports like Chabahar have proven their strategic worth, offering alternative access points that bypass traditional choke points. While India faces higher domestic fuel costs that affect everything from transportation to fertilizer production and food prices, the government has managed to cushion the blow through targeted subsidies and strategic releases from reserves. The net result is that Indian companies are gaining market share in refined fuels and pharmaceuticals, while the crisis reinforces India's push toward greater energy self-reliance through renewables and domestic exploration. What began as a vulnerability is being converted into an opportunity to strengthen economic resilience and geopolitical stature. Turkey occupies a uniquely advantageous middle ground. Although the country has faced short-term pressure from higher energy import bills and renewed strain on the lira, Turkish officials have wasted no time in positioning the nation as the natural energy and logistics bridge for the new reality. Russian gas flows through Turkish pipelines have increased substantially, bolstering Ankara's role as a key transit hub. Plans to develop Istanbul as a regional financial center have gained fresh momentum as businesses seek alternatives to Gulf hubs perceived as more exposed to direct conflict risks. The crisis has also revived interest in the Middle Corridor trade route, which connects Europe to Asia through Turkey and Central Asia, potentially capturing cargo volumes that previously relied on vulnerable sea routes. For President Erdogan, the turmoil offers a dual opportunity: advancing economic stabilization efforts while enhancing Turkey's geopolitical relevance as a mediator and indispensable partner. Long-term, Turkey aims to become a major energy trading hub, blending Russian, Caspian, and potentially renewed Middle Eastern supplies to serve European and Asian markets alike. Beyond these three prominent players, other beneficiaries are emerging in the shadows. Russia continues to benefit from higher oil prices and expanded market access in Asia, with revenues helping to offset the costs of its ongoing conflict in Ukraine. Certain Gulf producers not directly involved in the fighting have seen opportunities to adjust production and pricing strategies. Shipping companies equipped with appropriate insurance and rerouting expertise have seen freight rates and profits surge. Even some defense and technology firms in neutral or semi-aligned nations are experiencing increased demand as countries invest in greater security capabilities. The deeper significance of these shifts goes well beyond immediate profit and loss statements. The Iran crisis is accelerating the fragmentation of the global economy into regional blocs with their own preferred suppliers, payment mechanisms, and trade routes. Nations capable of maintaining diplomatic flexibility, investing in diversification, and moving quickly to exploit temporary dislocations are pulling ahead in this new environment. Those constrained by rigid alliances, slow decision-making, or over-reliance on vulnerable supply chains are falling behind, potentially permanently. This represents a historic reordering of energy power, trade geography, and strategic influence that will likely outlast the current conflict by many years. As fragile ceasefires hold and negotiations continue in various capitals, the real competition is already underway, not on the battlefield, but in boardrooms, ports, and energy ministries across Asia. While Western policymakers debate responsibility and short-term relief measures, China, India, and Turkey are executing longer-term strategies designed to emerge from this period of global turbulence with stronger economies, more resilient supply chains, and enhanced geopolitical leverage. The coming years will reveal whether the current energy disorder marks the beginning of a multipolar economic order in which adaptability and pragmatism trump traditional alliances, or whether the pain eventually forces a return to older patterns of cooperation. For now, the evidence suggests that some players have already read the new rules of the game far better than others, and they are wasting no time in rewriting the map of global economic power to their advantage. 1.7 Thuan.